Hello, this is our final video for the last unit, our final video overall. We are going to talk about monetary policy and the role the Federal Reserve has in forming it. So the Federal Reserve, or the Fed, is really the central bank of the United States. It's organized into 12 districts. It's led by a board of governors. The chair of the board of governors of the Federal Reserve System is Jerome Powell. It used to be Janet Yellen. The Fed is known as as the banker's bank. It provides banking services to banks all across the country, and it controls the money supply or the amount of money in circulation in the United States. So, with understanding what the Federal Reserve is and what they do, they control monetary policy. Okay? They change the money supply in order to influence the economy. So, the Fed influences the amount banks have to lend by adjusting interest rates. So just like fiscal policy, monetary policy is used at the same points in the business cycle. Once again, you have expansionary monetary policy and contractionary monetary policy. You're going to use expansionary policy when you are trying to bring the economy up out of a recession, and you're going to use a contractionary policy when you want to control inflation. So comparing the two side by side, fiscal policy is done through spending and taxes. It's developed by Congress and the president, and it can be tainted by upcoming elections, which would be politicized. Monetary policy is done through the money supply. It's developed by the Fed or the central bank, and it's free from election pressures because the Fed is not controlled by elected people. And looking at interest rates, they're used to calculate the amount of interest or the fee for the use of money paid on a loan. So you buy a car, typically you get a loan. You go to college, typically you get a loan. And the interest rates are essentially what the bank makes back on loaning you that money. A bond is issued by the government, and it's a debt instrument. All right, so they will sell these bonds out and pay out interest rates, or you will have to pay interest rates depending on which side it works. And the government uses this tool to help kind of control, or the Fed uses this tool to control the money. So the lower the interest rate, the more people will apply for loans. It's cheaper for people to get a loan, so they can buy that house, that car, they can go to college. Higher interest rates mean less people will apply for loans because it's more expensive. So, and looking at bonds and securities and expansionary and contractionary policy. Okay, an expansionary policy means the Fed would buy bonds. When they buy bonds, they're giving banks money. So that increases the money supply. So there's more money available to borrow, which means there'll be lower interest rates. Contractionary policy means the Fed would sell the bond. They want their money back, and they're going to give the bank the bond. This means that there will be higher interest rates because less money is available. They can also adjust what is called the discount rate. And the discount rate is the minimum interest rate set by the Fed to lend money to banks. So if they lower the discount rate, they are creating an expansionary policy because it's cheaper for banks to borrow money from the Fed, which gives the banks more money available to borrow or to lend out, which would lead to lower interest rates. A contractionary policy would mean the Fed raises the discount rates. So it would be more expensive for banks to borrow money, which means they'd have less money available to lend out, and interest rates would increase. They can also impact the reserve ratio, which is the minimum amount banks must keep in their vaults. So in looking at an expansionary policy, if the Fed lowers the reserve ratio, that means banks can lend out more money and they'll have lower interest rates. If they raise the reserve ratio, banks are required to keep more money in their vaults and they'll have less money to lend out, which will lead to higher interest rates. So that is an overview of how expansionary and contractionary policy work in regards to monetary policy in the Federal Reserve.